Want to see someone systematically disprove everything you have read about trading stocks and expose how and why you will consistently lose money if you aren't doing it right? Click the link in the description to check it out for yourself. But now for today's video.
The question, what are some common day trading strategies? Answer by Dinesh Shukla. OHLC, Open High Low Close, is one of the most famous intraday strategy. After 45 minutes of market opening, if the day low equals market open, one can initiate a buy with few pip below day low as the SL. After 45 minutes of market opening, if the day high equals market open, one can initiate a sell with few pip below day high as the SL. Pick courtesy, stocks on fire. Besides this, please keep the following things in mind. Strategies to reduce losses. Always wait for the right opportunity to enter a position, doing trading on every rise and fall in the stock price. Do not wait for huge profits in one trade. Take small profits and do multiple trades. Do not overtrade. People do overtrading and end up into losses. In day trading, no one has control over market and on stock movement, so if the stock direction reverses, then the trade will enter into losses. So it is always advisable not to overtrade. Use stop losses. Stop losses will reduce your losses to large extent if the stock direction reverses. Avoid using margin. If you use margin provided by the broker, then you may have to square off your trade before the market closes, whether you are in profit or loss. If you do not use margin, then you can take delivery of your shares if your shares go into losses. Strategies for capital management. It is advisable to use only 50 to 60% of your trading amount for day trading, and rest of the money is kept as backup or in long positions. Till you learn how to trade like a pro, you should only use your amount without using margin amount. This will help to reduce losses and safeguard your capital. To virtual trading practice. If you get success in virtual trading practice, then start trading with actual money. Do not panic and act on tips blindly. Review the same. Trading in FNO requires some extra expertise, so new traders are advised to avoid these instruments. You can read my below answer to understand how one loses money in stock market. Dinesh Shukla's answer to how do you lose money in the stock market, with examples. We also share such trading strategies and trade ideas on our free Telegram channel FIDA Stocks. Answer by Mike Taylor. My advice is don't. I did it as a part-time job for a short time when I was unemployed almost 20 years ago. Yes, I made money, enough to support the family in concert with my unemployment check. My upside experience. I played a contrarian strategy. I researched and picked about 6 stocks, 3 that moved up when the other 3 would move down. 4 of the 6 stocks were blue chips, and 2 were riskier, more volatile options to use. If the opportunity was right, I would watch the stocks daily. Though not always trading daily, usually weekly, I would wait patiently for upward moves in the 510% range, sell them and buy the stocks that had gone down. Then, as the stocks that went down came back up, I would sell them and move the money back into the other stocks that had since gone down, waiting for the inevitable seesaw effect. These ups and downs are precipitated by news. Most news is negative, so it is not unusual to see stocks lose value quickly. It usually takes more patience to wait for them to return back to normal. The reason the strategy works is not because I am smart. It is because people have psychological tendencies to assume that whatever is happening now will continue, for bad or good. So when the market is swooning, they sell, which is when they should be buying. And when the market is peaking, they buy, which is when they should be selling. It takes a lot of guts to make money decisions that are in direct opposition to everything you read. Reasonable strategy, right? So, why not continue playing it? The truth is, it is time consuming. Once I found a job, the job paid enough to rightfully consume all of the extra time I had. At that point it was clear that I could not serve both purposes. The job won my attention, as it should. Security for my family was a high priority, and day trading, while profitable, was not that kind of life. Downside, the stock market is now a very computer program driven profit harvesting machine. What I was able to do with $30,000 2 decades ago has changed. The profit trading ranges are tighter. It would now require putting over $120,000 at risk. Don't kid yourself. If you had $120,000 at risk, monitoring day trading moves will become a 45-hour/day commitment. And the last thing you will do at night will be to check the Asian and European markets, and pray that no fake news or real will pull the rug out from under you before you wake up. Your weekends will involve constant assessment of company news, ratios, macroeconomic variables, for an uncertainty, etc. You become a self-anointed prophet of profit. Furthermore, unless you have a superior memory, monitoring and working through day-to-day buy/sell decisions for more than 68 stocks can become very tedious, even nerve-wracking. You will make at least some bad decisions, blindsided by unforeseen events. One of my 6 companies, Nortel, eventually went bankrupt. This news was so unsuspected even by internal managers, that they were still extending job offers the very week that they announced the closing. Finally, there are records to keep on every transaction, and annual, if not quarterly taxes to track/pay with each trade settlement. Plenty of others suggest ways to make money in stocks, ways that work for them. My intent is not to discourage, but to provide a supplementary perspective. Edit number 1. I don't usually get this many views, so an edit is in order. I started out with, my advice is don't. I probably should have qualified that to mean 99% of people. There is that small percentage who have the cash to play with, the time to research/understand business fundamentals, and the emotional steadiness to play the game. The fact is, if day trading never worked, the question about strategy would never have been asked. Edit number 2, I am a total amateur. I had thought otherwise. One day both Warren Buffett and myself bought a very oversold GE stock in the $23 range. I initially counted myself as very smart for mimicking such a great investor on the same day and at nearly the same price, or so I thought. Then I watched in horror as the stock took a slow declining path to $14. I had no stop loss. I mean, after all, I was doing what the great Buffett did. What I did not know and could not have known is that Buffett had engineered his trade with considerable finesse. He had options in place, not just with the broker, but with GE itself, to purchase more if the stock went lower and to sell his $23 stock at his original purchase price. He was going to make millions no matter what the stock did. The amateur, me, had to wait several years for it to climb back to breaking even. Answer by Mark Montoya. Every strategy works until it doesn't. So if someone tells you they have a strategy that always works, in any market, they are full of BS. There are lots of different day trading types or styles. Some only trade the open, maybe the first 2 hours, and others trade the open and the close, and some people like me trade the whole day. That does not mean I am putting on trades all day, that means I patiently wait for trades to come to me. I do not chase the market. If I don't like what I see, I sit on my hands. I prefer high probability trades, where I can put on a little bit more size comfortably versus lots of small trades. The bigger size allows me to make a nice profit with a smaller move, but I often have to wait patiently. Some days I will sit for hours and hours, and never make a trade. I am perfectly fine with this, as I would rather put on a trade that I know has a good chance of working out, than trading because I need to trade and making a less optimal trade that turns into a loser. That is my style of trading. So here is a strategy that any day trader can use. Do not trade for the first hour. I would say 60% to 70% of the time, especially with the S&P, it will make the high and low of the day in the first hour to hour and a half of trade. So what can you determine from this? Well, if the market is up right from the open, and is still up after an hour, you may have a trending day on your hands and you would trade with it, not against it, and you could more comfortably buy the dips. I usually wait for the third 30 minutes candle to close, and make sure it's a higher high and higher low than the prior candle, before concluding it's a trend day. If not a trend day, and 70% to 80% of the time it's not, you will more than likely chop around inside the opening range, high and low of first hour or so. You will find they have double tops and bottoms on these days, so maybe you short the top or buy the bottom of the range. The key is to let the market sort itself out in the first hour or so, before you begin trading. My win percent went up significantly when I started using this method, and the number of trades went down. My average winner was also bigger, and my overall profits were much higher. Mainly what I wanted to do was avoid the market head fakes and chasing the market. I put on a long and it's up a few ticks, and then down 10, and I get stopped out. Then 20 minutes later it's back at my original entry. I try to make up for the loss I just suffered, so I get back in. When he takes a dip, I hold on because last time it shook me out and I want to get my money back this time. An hour later it's down even more, and I get out again. Had I simply let the market sort itself out, I would have never traded long, and noticed the up move was the shorts getting squeezed early. One other common strategy is trading gaps, especially when trading the S&P. Gaps of 5 points or less nearly always fill during the first couple of hours, and sometimes within 15 to 30 minutes. Not always, but a lot more often than not. Bigger gaps over 8+ points are harder to trade, but if the S-gap's up or down 5 points or less, you can almost always play the gap. It's the one time I ignore the don't trade the first hour rule. Most traders have gap rules they follow, and know these are great opportunities to make a high probability trade. Good luck.